What the fuck is quantitative finance? Let's cut to the chase. Some of the most profitable companies on earth don't have customers. They don't sell products, and you've probably even never heard of their founders. They operate in total secrecy, making millions of dollars by executing millions of trades faster than a human can blink. One of them, a man named Jim Simons, built a machine that made him richer than George Soros and Warren Buffett combined. He didn't do it by picking stocks. He did it with pure math. So, what exactly is quant? How do they make money? And how do you, as a viewer, join the quant world? By the end of this video, you'll understand exactly how these market wizards actually work. By definition, a quantitative analyst, or quant in short, uses advanced mathematics and computer programming to make money in financial markets. Forget the gut feeling. Forget buy low and sell high like all your stock guru online. Quants look at the market as a giant, chaotic dataset. They believe that hidden inside all that noise are predictable patterns and tiny inefficiencies. And if you're smart enough to build a model that can find those patterns, you essentially print money. They are the rocket science of Wall Street, literally. A huge number of early quants were physicists and engineers who left academia and the aerospace industry in the 70s and 80s, realizing their skills at modeling complex systems like, a rocket trajectory could be applied to modeling an even more complex system of the global economy. Their entire philosophy is built on three tools. First, algorithms. An algorithm is just a set of instructions, but in a quant world, it's a hyper-specific automated strategy. Think of it like this. A human might say, I think Apple is going to go up. A quant algorithm says, if the 50-day moving average of Apple's price crosses above its 200-day moving average and the trading volume is 1.5 times higher than the average, then buy 10,000 shares and place a stop loss order 2% below the purchase price. Do it in 50 microseconds. Statistical arbitrage. This is the art of finding tiny price differences between things that should theoretically have the same price. Imagine your local grocery store sells a can of Coke for $1, but the one across the street sells it for $1.01. You could run back and forth, buying and selling all day to pocket that 1 cent difference. Now, imagine a computer doing 1,000,000 times a second with stocks, bonds, and currencies. High-frequency trading, or in short, HFT. In this game, your biggest enemy isn't the market crash, it's the speed of light. HFT firms spend hundreds of millions of dollars on tech just to shave milliseconds off their trading times. They build data centers right next to stock exchange servers. They lay their own private fiber optics cable in the straightest line possible between Chicago and New York. Why? Because if their order gets to the exchange 5 microseconds before their competitors, they win. It's a war fought in units of time you can't even perceive. So how do they put these tools to work? Well, there are a few main strategies. This is the bread and butter for many firms. Algorithmic market making. A market maker is like the house at a casino. They don't bet on red or black. They just facilitate the game and take a tiny portion of every bet. Quants do this by placing both a buy order and a sell order for a stock at the same time in the right timing, based on factors like historical price patterns, trading volumes, and volatility metrics. The tiny difference between those prices is called the spread. They make a tiny fraction of penny on each trade. But when your algorithms are doing it for thousands of stock 1,000,000 times a day, those fractions add up to billions of dollars. Then there's derivative pricing. This is where it all started. A derivative, like a stock option, is a contract whose value is based on an underlying asset. Figuring out what an option is truly worth is an insanely complex math problem. In 1973, two guys named Black and Scholes developed a Nobel Prize-winning formula to do just that. Quants build on this model to find derivatives that are mispriced by the market, buying the ones that are too cheap and selling the ones that are too expensive. Finally, there's signal-based trading. Quants are constantly hunting for signals, any piece of data that can predict, even with a tiny edge, which way a stock is going to move. Stay tuned for this because in the next video, I'll explain how you can create these signals and potentially earn some money off of it. Okay, so back to what I was saying. These signals can come from literally anywhere. We're talking about satellite imagery to count the number of cars in Walmart parking lots to predict their quarterly earnings. The possibilities are endless. If it can be measured or tested, a quant fund is probably using it to find an edge. So after all that, you want in? Well, good luck. The path to becoming a quant is arguably one of the most difficult in all of finance. Forget what you know about Wall Street. They don't want finance or economics major from Rowton. They want PhD in physics, mathematics, computer science, or statistics from places like MIT, Caltech, or Stanford. The traditional pipeline of investment banking to hedge fund doesn't exist here. The pipeline starts at a university's advanced research lab. And you better know how to code. You need to be a killer at Python and C++ and have a deep understanding of algorithms, data structures, and machine learning. You need the kind of math skills that can derive stochastic calculus equations from a whiteboard while 3 PhDs stare at you. The interviews themselves are actually also notoriously brutal. So expect questions like, you have a coin that lands on heads 51% of the time. How would you structure your bets to maximize your returns while minimizing your risk of ruin? Of course, not all interview questions are like this. Some of them are way more complex and difficult. Ultimately, they're looking for one thing: raw intelligence and the ability to solve puzzles. So, what do you guys think? Heck, if this video gets 10 likes, I'll make another video to explain quant trading in detail.